Okay. All right, so filling out this credit card problem, we have our statement, and we're starting with a previous balance of $5,000. Okay, so then if we have a transaction, that's going to increase our balance. So we add $115 to our $5,000, right? So this will be $5,115. Okay. And what I'm going to do is I'm just going to stick with the balances first, and then I'll go over and do the days. Okay, so if we have a $65 charge, we add 65, so I'll have 5,180. Okay, then we have an $80 charge, so when we add 80, we get 5,260. Right, so we're just adding to our balance as we go. Okay, and in this example, we didn't have a payment that we made. Okay. So, adding the 80 gives us 5,260, adding the 160 gives us 5,420, and then adding the 145 gives us 5,565. Okay. And now what we're going to do is we're going to see how many days do we have each of these balances. And the first one is done for us. From January 1st to the 7th is 6 days, right? You can just subtract the dates to get how many days, right? From the 7th to the 9th is 2 days. Okay, 9th to the 10th is 1 day. 10th to the 12th is 2 days. 12th to the 26th, when I subtract, I get 14 days. Okay, and then for the end, we have to be a little bit careful. There's 31 days in January, but we want to count the 31st as one of these days. When we do the subtraction, right, 12 minus 10, we're not counting 12 as being one of the days for this balance, right? We're counting 10 and 11. That's the two. Okay, so here we want 26th, 27th, 28th, 29th, 30th, and 31st. So we want 6 days. So you want to make sure that your total number of days adds up to 31, right? And I think if we double check this, 6 plus 2 plus 1 plus 2 plus 14 plus 6 gives us our 31 days. Okay. Now it's possible when you load this question that 2 of these dates are the same day. That's okay. The first one would just be 0 days. And the way that works is the credit card company, when they compute your average daily balance, they're averaging your balance over each day, and they're looking at your ending balance each day. So if you have more than one transaction, they would just add up on top of each other. Okay, so now to compute the average daily balance, what we're going to do is average all of our 31 days. Since they're repeated, instead of adding 5,006 times, we can just multiply them. Okay, so I'm going to put parentheses, and I'm going to put 5, oops, where did that go? There it is. 5,000 times 6 plus 5,115 times 2 plus 5,180. It's times 1, so I'm just going to leave it. Plus 5,260 times 2 plus 5,420 times 14 plus 5,565 times 6. And I take that whole result and I divide by the 31 days in January. Okay, so we get $5,329.03. All right. Yep. All right, number 6. Good. Okay. Then next, what we do is we say, all right, let's go ahead and do some further computations, but the separate problem. So we have a credit card, just like we did before. Okay, this time we're told what the annual interest rate is. And we have a statement balance for the end of the month, $9,400. And let's suppose we've already computed the average daily balance, $9,306. Okay. Find the interest charges for the month. So to find the interest charges, we use the average daily balance. Okay. For finding the amount due on your next bill, you do not use the average daily balance. Okay, so to find the interest, we take our average daily balance and we multiply that by the monthly rate. Okay, so our average daily balance is $9,306, and our annual rate is 18%, right? As a decimal, that's 0.18. To make that a monthly rate, I divide it by 12. Okay, so we get $139.59. Okay, then to find the amount due on your next bill, what we do is we say, all right, this was our ending balance, and then for the amount due, we take our ending balance plus the interest. So we take our $9,400 and we add the interest. Okay, so your ending balance is like a real number. That's how much you actually owe. The average daily balance is just this computed number that we use to find out what the interest charge is. Okay, but it's not the amount that you actually owe, so we don't use that for your amount due. Okay, does that make sense? Any questions over the credit card homework?
Sorry, I couldn't find my unmute button for the longest time possible. Okay, so for this question,
Yep.
all you have to do to find the first box is pretty much take your like statement balance for the month, multiply that by the obviously the percentage, and then over like monthly, which is 12, and that's how you get your average daily balance.
No. So you're for this one, you're given the average daily balance, right?
Oh, okay.
We're told that the average daily balance. Oops, let me highlighter bigger. On this one, we're told that the average daily balance is $3,906. If I wanted to find the average daily balance, I need the actual statement. So, like on the previous question, right, we get the statement, we can see what our balance is on each of these days and how long we had that balance, so we can compute the average daily balance. Okay. On this one, since we don't have the statement, we can't compute the average daily balance on our own. Okay, so that's why it's given to you. But to find the
Oh,
interest charge, you have to use the average daily balance. You don't use your statement balance.
okay. All right. I think I got it. Thank you.
Yeah. So one thing to note of that, let's suppose that I pay my credit card before my bill comes in, right? Let's suppose the bill comes at the end of the month and I pay it on the 25th. So I owe nothing or next to nothing. Well, I mean, if you pay off your whole bill, you never have interest charges. But let's suppose I pay off almost everything. That doesn't matter. They'll still charge me interest based on, the days that I did owe something.
Hmm. Thank you.
Okay. Any other questions? Okay, so that's the credit card stuff. I think maybe what we should do is go through another example of the computing uh, the income tax. And I'm going to put that homework out later on this morning. So we'll have this up for reference. Maybe we'll put that aside for now. Okay, so let's do an income tax example. All right, so let's suppose, for the examples, I like to do examples with a lot of income because then we end up using more tax brackets, so it clarifies things a little bit better. So if you only have a little bit of income and only use 1 or 2 tax brackets, I think that that's a simpler problem. Okay, so I'm gonna do a more complicated one. So let's suppose we have a married couple. With gross income of, let's say, $230,000. Okay, and let's say that they have $16,000 in adjustments. Okay, $20,000 in deductions. Okay, let's say they have 2 children. Okay, and let's suppose that they have so far paid let's suppose they've paid $27,600 in taxes so far. Okay. All right. And what we want to do is sort of run through the whole list. Instead of writing out all the things we want to find, I'll just write them as we go. Okay. All right. So we'll say, step 1, find the adjusted gross income. Which from this point on, I'll abbreviate as AGI. Okay. So in order to do that, the adjusted gross income is the gross income minus the adjustments. Okay. Their gross income is $230,000, and we take away the $16,000 in adjustments. So we get $214,000. Okay. Okay. Step 2, let's find their taxable income. Okay. So this is the part where we have to subtract out the deductions. To give you a little bit of history, prior to 2018, we would also subtract out what are called exemptions. And an exemption is just a flat amount of money per person, right? So you have a married couple, 2 children, that's 4 people. So you take the exemption times 4 and subtract that out. But I'm not going to write that. That's not in the tax code right now. So until the tax law changes and they bring that back, I guess it's a moot point. So, all right. So for the taxable income, we have to figure out, do we want to use their itemized deductions or the standard deductions? So it said in the problem that their itemized deductions are worth $20,000, and the standard deduction okay. What we want to do is, go back to our notes and say, okay, for a married couple, the standard deduction is $24,800. Because the standard deduction is higher, we use that. Okay, so that means that our taxable income is our adjusted gross income minus the deduction. Okay, so we have $214,000, and we're going to subtract out our standard deduction. So that's $24,800. Okay. I'm not going to pull my calculator up onto the screen just because this is, if I'm just doing subtractions, right? We're good with that. Nothing fancy here. Okay, so the next step is the complicated one. Okay, here we want to find the computed tax. Okay, so what we have to do there is we have to take a look at the tax brackets. So they have $189,200 in taxable income. And if I look at my tax table, 189,000 falls into this 24% tax range. Okay. So when I put my computed tax in here, we're going to have the 10% bracket full, the 12% bracket full, the 22% bracket full, and then a little bit of remainder in that 24% bracket. Okay. And reading off my table, the 10% holds up to $19,400. So that's full. The 12% bracket holds the money from $19,400 to $78,950. Okay, so I'll just show that real quick. So it picks up where the last one left off and goes up to the next one. Okay, so what we want to do is we want to subtract in order to get how much that can hold, right? So when I subtract, $78,950 minus $19,400, okay, I get $59,550 of that taxable income is going into this bucket or this tax bracket. Okay. The 22% one says it goes from that $78,950 up to $168,400. So if I take $168,400 and I subtract $78,950, that tells me how much this bracket can hold. Okay, so this one can hold $89,450. Okay. The 24% bracket, we're not able to fill up because we fall into the middle of it. So we don't want to look at how much this bracket can hold. We want to look at how much of our money is left to put in this one. Okay, so we've accounted for money up to that $168,400 because that's where the 22% one leaves off, right? This holds money up to this $168,400. So in the 24% bracket, we say, okay, from $168,400 up to the amount of money we actually have, right? How much is that? So we take our $189,200, subtract the $168,400. Okay. So this one is our taxable income. Okay. So when I subtract those, okay, we get $20,800. Okay, and what I've said before, I think a good way to maybe double check what you're doing here is to add up how much is in all of these buckets, right? So I have 19,400 in the first one. Okay, 59,550 in the second one, 89,450 in the third one, and 20,800 in this last one. And they should add up exactly to our taxable income. Okay. Okay. Because what we're really doing is we're taking our taxable income and breaking it up into these groups. Okay. So if they don't add up to our taxable income, we didn't do it right. We either, got some money out of nowhere that we're paying taxes on, or we didn't account for all of it. Right. So then we compute the tax, and then that's just taking the percentage, right, which we have written on top, of the amount of money that's inside it. So we're going to take 10% of 19,400. We're going to take 12% of 59,550. We're going to take 22% of 89,450. Okay. And for this last one, put it down here a little bit. We're going to take 24% of 20,800. Okay. So our computed tax is these four numbers added up, right? The 1940 plus the 7194 plus the 19,679 plus the 4,992. Okay, so we should get $33,805. Okay. All right, that's step 3. Step 4 is to subtract off the credits. Okay. And, there's like millions of credits out there. So when, and like I said, I haven't put it up yet, but when you see the homework on this, the credits are going to, be included in the problem so that you're not fishing around with tax laws or anything like that looking for credits. Okay. So in this one, the 2 children is because we're going to get the child tax credit for each of them. Okay. So there's a $2,000 per child tax credit. So we're going to get $4,000 credit. Okay. So the tax is going to be $33,805 minus $4,000. Okay, so that's the total amount of tax that this family owes for the year. Okay, and then as a last step, we can say, all right, find the amount owed or refund, right? Okay, so if we go back up, it says that they paid $27,600 in taxes for the year. okay, which is not as much tax as they owe, which means they have to pay the difference. They're not getting a tax refund. They have to mail a check to the IRS. Okay, so they still owe the difference. Okay. That's everything we have. Is there any questions on that process? All right, well then, any other homework questions you want to take a look at? Okay, if you do come up with something, let me know or stick around. Otherwise, I think that we're good for